want to talk about this situation that happened with GameStop, right? And so a lot of people are saying, they've been actively investing, they've been longing GameStop, and a lot of people have been making a lot of profits, and I'm so happy for them, right? But I do realize that with a lot of people participating in the markets, not a lot of people actually genuinely understand what is going on, nor do they really know what's happening. I do believe, from the text that I've received from a lot of my friends and a lot of people I've discussed with, it's a lot of mob mentality that's been occurring. And I want to help you guys really get an understanding around what is happening and where your money is going. In order for you to understand what happened with GameStop and why this blow up occurred, let's go back to the beginning and understand that what it meant when people were saying these hedge funds are shorting GameStop and why they were doing so, right? So typically short sellers will see something within the trends with the GameStop. Obviously those of you who are gamers realize this. A lot of games are going, or services are going cloud. Not as much need for a company like GameStop. And as a result of that, hedge funds and other institutions are saying, look, they're going to go bankrupt. They're assuming that they're not going to be able to perform as well as they used to. So let's short them. So a short essentially is when a individual, let's say you guys, decide to borrow a stock from a broker and sell it immediately at that price. So let's say, for example, one of your favorite stocks, let's take Tesla, for example. I'm not going to use Tesla's real ticker price. I think it makes the math too difficult, but let's say for simplicity's sake, Tesla was worth $10. So you essentially go up to a broker and you say, I want to purchase one share of Tesla stock, and you borrow it from the broker at $10. Your hope is that after you purchase it, you would immediately sell it and you had $10. Your hope is that eventually that value of that stock would fall such that you can buy the stock back at a later point and return the shares that you've borrowed to the broker, that one share, but keep the difference in the value, right? So let's say that I bought Tesla at $10. And I have that share. I borrowed it from the broker and I sold it immediately. So I had the $10. And then once the price of Tesla, I was assuming that I was going to cut down, let's say it falls to $6. I cover which essentially what covering is essentially you're buying back that share that you borrowed or from your position. And you buy the share back at a lower price. Let's say, for example, in this case, $6. So initially, right, for math's sake, I had borrowed it at $10. And now in my short position, I have covered my trade and bought back that same exact share at a price of $6. So now I made a profit of about $4, right? Because I made $10 when I sold it, and then I had to repurchase a share at $6, and my difference here is $4. Now that's very good, right? That sounds wonderful. We love that. Shorting a stock, being able to make money off of that. That's the beauty of the free markets. But I cannot stress this enough to people is that shorting stocks, in my opinion, and obviously in respects to many, many investors, is one of the riskiest trades you can make. The reason is that let's say Tesla doesn't actually drop down to the $6, right? That I assumed it could, and then I was going to cover my trade. Instead, Tesla goes up to $20. Now, I borrowed that initial stock from another broker. So now, not only have I borrowed that stock, but I actually have to pay more money because I have to buy back that stock. So if I buy back that stock at $20, I can return my shares I borrowed, right? That one share that I had borrowed at $10, but I will also have amount of losses accumulating to nearly $10, right? Just by selling at 10 and then rebuying at 20. Since a price can rise indefinitely, this is what brings so much risk to short selling. At some point, you will have to decide to buy back those shares that you borrowed. And then as the price increases, the more your losses will be. So now let's take GameStop, right? You guys have understood how shorting works. A few weeks ago, what really started happening, actually, I think it was almost a couple months ago now, many members on Wall Street Bets had noticed that hedge funds, and specifically Marjan Capital, had taken massive amounts of short trades against GameStop. Wall Street Bets had convinced people to say, no, we're not going to let this institution stop us. We're going to say screw the institution. Instead, we're going to buy as much GameStop stock as possible. And this made the price rise because essentially what was happening is the retail people who are part of Wall Street Bets were saying, no, we want to stick it to the guys up top. And so that made the price rise because of all the capital that's inflowing into GameStop. I'm sure that the CEO of GameStop's just sitting there one day. He's looking at his bank account. He's realizing he about to go bankrupt, and then all of a sudden, you guys help pour millions of billions of dollars into his company, right? I think his corporation almost reached $20 billion valuation at one point. Aside from that, this price raise had actually caused all of those hedge funds who hosted a short position in GameStop to lose billions of dollars. Their losses at one point had even surpassed a total amount of, I believe it was between 13 to 14 billion dollars. And that hedge fund essentially, they decided they had to close their short positions. And then as a result of that, they had to file for bankruptcy because they had to buy back all that GameStop stock at once at much higher prices. Right. And since they wound up buying back those GameStop stocks at higher prices, that even drove the prices higher. So now, with them essentially being squeezed out of the market, right? So that's where the terminology of short squeeze comes from. Is essentially they found out that the hedge fund was shorting, people dump money into the market, and then that results in them having to give up those positions and buy back to hedge against their losses. But in this case, not much hedging was done. And this caused all of Wall Street to come together and say, dude, this is not fair. The little guys are hurting us. But really, what they had done, and this is why I show no remorse, is retail had beaten the hedge funds. We had beaten Wall Street at their own game. You're wondering, okay, in that, I gave my explanation, but what exactly are my thoughts? My opinion is that this is genuinely a good thing, right? Because what this points to is what I've always wanted is a decentralization and the empowerment of individual investors, regardless of their size or their power or their pocket size, right? The reality is that everyone should have the right to participate in the free markets. And that's what it's about. It's about capitalism and being able to get rich and being able to do things that anyone else can do. Now, I think that there are other arguments to be made here. So let me go ahead and just take a quick look here at one aisle or one side of the arguments, which is regardless of your take, this is good in regards to decentralization, but this is another example of pumping assets that is usually frowned upon, right? When we talk about the pump and dump scheme, this is something that could easily happen with the way that the markets are being built up right now. And this is essentially a major pump and dump scheme where the major option traders who have larger positions in GameStop will actually wind up profiting big time, right? For example, I think it's cool that the Wall Street Bets and all of Reddit and whatnot were able to come together and say, hey, look, there's a stock that's being beaten up by hedge funds. Let's go ahead and try to prevent that price from occurring. Instead, let's pump it all the way up so that way that they wind up getting squeezed out of the market. In regards to having remorse for the hedge funds, heck no. I have no remorse for the hedge funds because these guys have been doing what happened yesterday or for the past week for decades, right? I genuinely believe that there has been market collusion by these private market players, such as hedge funds and large institutional investors. So it is good and that finally the retail market was able to do something about it. But with that being said, it's still a pump scheme, right? Where the pump group has decided that they want to buy this stock. And what will eventually happen is I know that the initial person that had purchased these, who started the thread, right, on Wall Street Bets was an individual who had put nearly $50,000 on a long position, and he's made millions and he still hasn't sold. But the question winds up becoming is what happens when he does sell, right? Because if he sells, I genuinely believe that, just like when Wall Street Bets started pouring money into it, they would want to sell their positions as well. Well, because they're going to say, well, the guy who started it is taking out their money, so should we. It's a very cultaholic environment, right? Because essentially saying, well, if, let's say, for example, if you're a religious person, and you believe in religion, and there was somebody who came down and they provided you with the text and they say, this is the religion, this is what we should follow. And all of a sudden, everyone's starting to believe it. They're coming into it. They're also believing into the book. And then they turn around and say, the guy who started it says, oh yeah, this book is lame. It's not really what I want anymore. And he throws away that book. Well, genuinely, all the people that joined him in that cause, in that rebellion, are going to turn around as well and say, this book, this thesis that we had created is no longer worth it. And they're going to throw it away as well. So be very careful when you get active into these sorts of markets, because eventually what will happen is there is going to be a sell-off point, and that sell-off is going to be very, very major. So that's my take on this situation. I think it's positive for decentralization of the marketplace. It's positive because hedge funds finally got a taste of their own medicine, but it's something to be very wary of in regards to the potential downfall for retail investors. So like I always say, do research, be very savvy, and make sure to take profits as you can. Man, it's been a crazy week when the app that you thought that was going to help you essentially democratize the way that investing is done and take you to places where, a lot of hedge funds and billionaires didn't want you to go, and now is be able to participate in the markets and make a ton of money, turn their backs on you, or at least that's what you've been told, right? So the past week, we've seen a large amount of backlash against Robinhood, and rightfully so. But I think the backlash against Robinhood is not focusing on the real problems. Instead, it's focusing on some of the high level issues that people are not willing to dig into. But don't worry, you have me, and I will dig into them for you. So on one side, I think Robinhood is absolutely responsible for not being able to communicate. They are responsible for not being able to communicate why they decided to halt trading and force users to essentially sell their positions. That is something that the CEO, Vlad, and other people on the Robinhood team need to be held accountable for. But there is a little bit more to that story than just the idea that Robinhood was essentially, calling up individuals, and they were, trying to get DTCC to raise the margins, and they were forcing the shutdown of speculative buying, and they were providing all that information to hedge funds. Let's focus on what the real issue is, right? So to get to that point, we need to understand what Robinhood is, right? Robinhood is an app, right? Robinhood is actually a broker, but they're not a broker in the sense that they execute stock trades, right? Instead, what their job is to sign up customers, and then what they do is route their orders to executing brokers. And their job is to keep a track of who owns what, right? So Robinhood is also its clearing broker on the back end, right? So they directly settle and take custody of the client securities, right? So when Robinhood is being paid by Citadel, yes, that's true. They are getting paid by a broker to execute some of Robinhood's order flow. This is not a bad thing at all. Citadel is a company, its equity securities is paying to execute retail orders on behalf of Robinhood, because that is the way that these positions are going to be filled. So Robinhood customers are allowed to buy and sell stocks, but the issue now, and this is where it starts to get a little tricky, and where the real issue arrives, is those trades don't settle until T plus 2. For those of you wondering what the heck I just said, what is T plus 2? T plus 2 is the time it takes for a settlement to occur. And settling is the closing and the exchange of cash for security. And usually that occurs from the time of the transaction 2 days afterwards. So 2 days after the time of the transaction. And depending on that net amount of buys and sales, let's say for a certain stock, Robinhood is actually responsible for paying or receiving that net cash. And what that essentially difference is, or that spread, is what we call credit risk. So Robinhood is responsible for covering the credit risk of those trades that were placed. Now, how is that credit risk determined? Well, that's actually determined by the NSCC, who takes on that credit risk. Their job is to match up the net buyers and sellers post-trade and handle the exchange of cash for the security. So to mitigate the credit risk that one of the clearing brokers fails or something like that, in the case that there's a downfall, they demand that the brokers actually post a clearing deposit with them. So the NSCC will go through Robinhood during this whole entire time where a lot of people are just dumping large amounts of money into their app and saying, look, there's a settlement time, but between then and now, we need you to provide a deposit to cover these trades that are occurring. That's credit risk. So who's responsible for credit risk, and where does this come from? This actually comes from the NSCC, which stands for the National Securities Clearing Corporation. What the heck is that? So National Securities Clearing Corporation is responsible for matching up the net buyers and sellers, their post trade, and handling the exchange of cash for the individual security, right? So when I'm purchasing, let's say when I'm going and buying the GameStop at the time, it takes 2 days for that settlement to occur. Their job is to actually take that trade that I've put together, post trade, and handle the exchange of cash that's provided to them from the broker, and provide the user, or in this case, the broker, with the security itself. So to mitigate that credit risk, what they'll do is they ask from the clearing broker themselves a clearing deposit with them. So to ensure that if the clearing broker fails on the trade or whatever happens, something messed up happens, they demand that the broker actually post a clearing deposit with them. And many of you guys may be wondering, well, why does this occur? Why is the NSCC required to do so? The NSCC is required to do this by SEC rule, and that traces back to the Dodd-Frank Act, right? The reality is the people who are responsible for this entire situation, and in fact, believe it or not, surprise, surprise, the government, right? The government, who has always been attempting to regulate and put restrictions in hopes of protecting the little guy, wind up actually harming them and causing a lot of issues within the free markets, because by putting in these restrictions, it's actually causing a lot more friction for the markets to do what they're supposed to do, and that's act freely. So this occurred actually after the recent 2008 financial crisis. And after the crisis, encoded in the Dodd-Frank Act, was they wanted to ensure that by making everyone post collateral, this would reduce the credit and systematic risk of short trades or any sort of trade deposits. So there's a whole entire formula that goes into the NSCC deciding how much that clearing deposit has to be. But once that formula is decided and the NCC institutes that, they lay the framework out, and then by law they have to enforce it, right? They have to enforce it by the Dodd-Frank Act. These deposits are then held at a clearing fraud at the NSCC. What the NSCC does impacts directly the broker, and in this case, it's Robinhood, right? The one who is taking host of your assets. How does this impact Robinhood? So let's understand how this NSCC rule impacts Robinhood. And to understand this, let's talk about maybe the amount of money that may be coming into Robinhood. At any given time, let's say, for example, almost $1 billion of new money has entered into Robinhood. And out of that new money, let's say 500 million has decided to buy GameStop. Then at a minimum, if we take into account the current cover collateral that's required by GameStop, let's say that cover collateral required by the NSCC is actually, let's say, 10%, then just by the fact that $500 million is buying GameStop, at a minimum, they're required to post, they being Robinhood, to post $50 million for the exposure for that credit risk. And they can't use the client's money, right? You'll be like, oh, well, they have $500 million. That's no problem for them. They can cover it. By law, they can't utilize the money that's being used to essentially fill the trade by its clients to post as collateral. Instead, Robinhood is now responsible for utilizing their own resources and posting that as collateral. And if GameStop stock drops, Robinhood has to post the loss pre-settlement, right? They still have to post that. So this is kind of an explanation as to why people even saw Robinhood drawing credit lines, because they actually had to cover their clearing requirements, because by law, if they hadn't, there would be huge issues. So when people are asking, well, what is the problem here? The problem here is that The policy's goal is to avoid the central plumbing entities from taking credit risk, right? We don't want these centralized, government institutions taking on credit risks. So in reality, these regulations raise the costs and they create severe barriers of entry for these brokers like Robinhood, and especially for investors like us. It raises profits, though, for guess who? That's right, these centrally owned institutions like the DTCC and the NSCC, and the NSCC, as you guys know, is obviously controlled by the Wall Street itself, and then DTCC is a government-owned institution, right? The Department for Trading Clearing Commissions. When Robinhood opened up the stock market investing more broadly, they had succeeded in their goal, right? They were able to essentially bring on a whole new level of retail investors to the game. That's why we love Robinhood. But what Robinhood does not change regulation. Regulators are still as pro Wall Street and pro current rules and regulations and capital requirements as they have ever been, because that is what politicians do, especially those who love government regulation. And we're one of the most regulated, if not the most regulated financial market in the world. So these people who are coming out as your knights in shining white armor, the Bernies, the Elizabeth Warrens, who's Elizabeth Warrens I'll address directly, but even AOC, right? I think AOC was right in asking, hey, how can it be that Robinhood stopped its clients from buying certain securities? I would like that when she asked that. But if she just dug a little bit deeper, guess what she would have found? It was people just like her 10 years ago who had put into place this law called the Dodd-Frank requirement, requiring brokers like Robinhood to post collateral to cover their client's trade pre-settlement. And guess what? It isn't the Fed or the SEC who sets the rules, right? It's the Wall Street owned central clearing entity itself, DTCC, that's making its own rules. So when the retail masses decided to squeeze these short sellers in the middle of crushing them, it was government regulation that screwed that whole entire opportunity up for them. So retail were destroyed by the very entity that's supposed to be governing them, and that was the government. And recent news has come out that at the time of this trading frenzy, the DTC has actually even exercised its right to add additional margin charges for these set of stocks, right? They had essentially put together a system that required, the formula that you can go and read yourself. They required brokers like Robinhood to cover even more amount of credit risk. So the reality is that, yes, Robinhood was responsible for the lack of communication and stopping the trading. But if you looked underneath the hood, the reality was because they were required by law to do so. And not enough people are talking about this, because the issue is with mob mentality and groupthink that took over social media. Everyone wants to blame the app, but no one's really willing to check underneath the hood. And Robinhood had to stop trading because the law required them to do so, because if they couldn't provide the capital to cover the credit risk, they would have been shut down, and a lot of people would have lost their money. You're talking billions of dollars worth of trades that would have been frozen and would have been, lost, because the piping and plumbing of this financial infrastructure is what's broken. So how can we fix that? That's the main question we should be asking. As many of you may have heard, you may have seen your favorite politicians, whether it be Bernie Sanders, Elizabeth Warren, AOC. They were all coming out and they were saying they were asking some really good questions. They're saying, well, why did Robinhood do this? But now what the narrative has turned into, and this is a direct quote from Elizabeth Warren, is they said, quote, casino-like swings in the prices of GameStop reflect wild levels of speculation that don't help GameStop's workers or customers or could lead to market instability. Today, I told the SEC to explain what exactly it's doing to prevent market manipulation. But you know what's funny about this? Now, many people will be like, oh, market manipulation, that's the word that they've used and chosen here. But these are the same people, if I remember, especially Senator Warren, you were a former TARP administrator who in 2008 actually had provided nearly $800 billion of taxpayer money to bankers in the government bailout of Wall Street. That was you, I remember. And to anyone else, right? And to those other people who are sitting there and wondering, well, what's going on here? Don't worry, we can explain this as well. I know, remember Bernie Sanders just came out recently and said we should tax these Wall Street speculations. We should put a financial tax in place. Um, hmm, what would a financial tax do? Well, let's say even if it's 1 to 2%, that doesn't sound like a lot, especially if I'm doing $100 trade, right? Let's say, for example, I've done a $100 trade. $100, 1 to 2% of that is not a lot, right? That's only $1 or $2. That doesn't sound like anything, in fact. Well, in case you're wondering, this is the exact reason why these individuals like Senator Warren and all these other people who have put together a proposal to tax us have never been on the side of decentralization or the little guys. Because 1 to 2% tax, let me tell you when it becomes a problem. On $100 transaction, $1 to $2 isn't a problem until you decide that until the market decides that that stock is no longer worth $100 and instead it's not worth 1,000. So 10x return that you could have been expecting, you've lost nearly 10 to 20 to $30 based off the financial tax that could be put into place. And then on top of that too, let's think about the what they're saying here. So for decades, we've known that shorting and speculation and understanding market narratives have been a big part of hedge funds, and hedge funds have actually manipulated stock prices for decades. But all of a sudden, what these knights in shining white armor have decided to say is it's become a problem when the retail investors have decided, no, we want this to occur. Now it's a problem. Hedge funds have shorted nearly 120% of all available stock in GameStop. It's illegal under existing law to short more than 100%, but Senator here isn't worried about that and says she's worried about billionaires are getting their I won't use any language on the show, but billionaires are essentially having their long due karma finally returned to them because they've been doing this for a long time. I don't feel bad for the hedge funds. I feel bad for the little guys and the little guys who are being manipulated by these so-called politicians who are saying they're acting in good faith, but they aren't. And that's a big problem. And this is why we need free markets, because a free markets allows us to be able to participate and partake in these trades and be able to make, risky assumptions. Yes, if people get burnt, they get burnt. So what? Let people understand the markets. The best way for people to learn is sometimes you have to fall down flat on your face to learn how to get back up, right? You don't, when you were a kid, you were told don't touch the hot pot. And you know what you did? You would touch it and you would get burnt and you would learn that way. All right, I will never touch this hot pot again. We need to allow our investors to get their hands dirty. These are the same people, like Senator Warren and, the AOCs and the Bernies and the world. They're the ones who put into place these stupid rules around accredited investors, right? This accredited investor verification, all these things like that. There's no reason in today's market why anyone needs to have a certain amount of money to prove their ability to invest. Right? I don't need to have $200,000-$300,000 worth of salary per year to be able to go and partake in a pre-IPO or in a real estate deal, etc. Right? I don't need that kind of money. Instead, what I need is knowledge. And today, regulation is actually acting very counterintuitively to innovation and technology, because with the world of technology today and for the past 10 to 15 years, information is available like no other time in history. Today, if I wanted to learn about Robinhood, if I wanted to learn about the process, if I want to understand the rules and regulations put into place already, I can do so with a simple Google search. So what we need to do is empower technology companies to continue to innovate. We need to empower people to continue to take risks and invest and understand where they can lose money and how they can lose money, instead of saying that we're putting these rules into place to protect the little guys, when in fact it is only blocking them out. And the best example, like I said, is that accredited investor rule, which is preventing the decentralization of markets. It's the biggest killer to the American dream.